Hello and welcome back, everybody, to the Pulse here with the PeakBot team. I am Dillon Del Rosso, co-founder and co-host, joined by my co-founder and co-host Ben. Ben, how you doing this morning?
Doing fantastic. I am back down the Jersey Shore for not 1 week, but 2 weeks. So a month
Nice.
ago was with the in-laws. These 2 weeks is with my family.
Awesome. Little business and pleasure. I know you can't put the laptop down, but hopefully you can enjoy yourself while you're down there. I know you will.
Can't stop,
And
won't stop.
and the best part is while you're on the beach eating a turkey sandwich and playing football or doing whatever you're doing, you're gonna have your bots trading for you. PeakBot's got your back. So
Oh, yeah.
excellent. Yeah, new setup for you this week. We're excited to get into today's show. We have a great agenda for you today, as well as a special guest, a guest that we've had on before. So I won't spoil it just yet. You're gonna have to hang around. So for anybody who's new to the show or new to PeakBot, just a very quick high-level introduction. PeakBot's an automated trading platform, specifically in the world of options trading, and even more specifically, selling options, because we love collecting premium. We have taken well-known, time-tested option selling strategies that have been around for decades, and we automate them for the everyday person by making it easy, affordable, and transparent to start trading hands-free, a stock trader in your pocket. We're integrated with fantastic brokers like Tradier, and as well as many other big brokers here in the States and internationally. Yeah, that's enough. That's what you need to know about PeakBot. If there's questions, don't hesitate to ask. Please put your questions live in the chat. We're happy to answer them. Or you can message us at the number below. Text or call us. That's our business line. And if you want to know more, you want to get one-on-one with the PeakBot team, schedule some time. pkbt.app/meet. Happy to give you a product demo, walk you through, make sure you're fully comfortable before you get automated. And lastly, this is not financial advice. Nothing we say ever is financial advice. We're not financial advisors. So, yeah, just don't forget that part. Very important.
Thank you for that disclaimer, Dylan.
Yeah, so it's out there. Ben, I'll kick it to you. I believe you got some watch list updates for us.
We do. And I'll pull up the watch list on my screen here. So this is the in-app watch list on the PeakBot web app. For anybody that's been following the whole watch list evolution, we've moved from having it on our website to then just having it on the alerts page, and now we also have it on the web app. So the accessibility to the watch list is growing week by week. We're also adding more and more data as we can, and we brought back the vertical wheel watch list because that was previously only available on this first set of watch lists that we've provided. So if you do have a PeakBot account, you can log in. If you don't have a PeakBot account, go make one, app.usepeakbot.com, 30-day money-back guarantee. Then you get access to these watch lists that update every 5 minutes. So we did add the vertical wheel watch list back in. I'll zoom in here. And as we can see, we've got a little legend up top to let you know what each column is talking about, what data that column is giving you. And then we're sorting these columns based on the expected value. We've covered expected value in past shows, and we covered it on our social posts. So feel free to go look at that and see what's going on with expected value. And then we're indicating whether PeakBot is bullish or bearish on a particular position. And we're also indicating what the perceived level of volatility is. And this is all color coded. So can I scroll? I don't know if I can scroll when I'm zoomed like that. Yeah, it looks like I can a little bit.
There you go. You figured it out.
So you can see bullish, bearish, and neutral. If the trend is bullish, we know that we'd rather be on the put side of the wheel strategy, specifically here the vertical wheel strategy. And if the trend is bearish, we would rather be on the covered call side or call credit spread side if we want to continue to hold the shares, right? And then neutral, and Dylan, we've talked about this many times. The beauty about selling options is you could still win if a ticker is neutral. You could still win if you're X% wrong on these option plays. So That's really great. And of course, we do cover the buying power needed if you are assigned. So this is different than what's needed for the trend spread strategy, where you only need the width of the spread. For this strategy, we are going to let these contracts expire. If they expire in the money, you could get assigned. And actually, we'll talk a little bit about that with our special guest that we're about to bring on stage. We've got the estimated put premium, and then we've got your estimated ROI, max loss, earnings date, and then we've got some strike prices that you can scroll over and see there. Again, the bot's going to be doing all of the choosing for you in terms of the strike prices, but it's still good to get an idea of where that should end up. So that's a big update we've made to PeakBot's watch list page. We also made some updates to our partners, our subdomain partners watch lists. So I've got Bull Trade Finder pulled up here. And all we've done here is we've done a little bit of sorting and color coding to make these watch lists a little bit easier to read. And we also added in the strike prices if you are curious what the bot would buy or sell. So on this one, bearish tickers are highlighted in like this matte yellow, call it. And then the bullish are in green, not showing neutral. That'll be a new addition for this coming week. But then we've got the expected value column here. If it's positive, it'll be green. And if it's negative, it'll be red. And of course, we're always looking for a positive expected value. And then we just have a basically like a heat map on probability of profit. So those are some updates that we've made to our watch list, our subdomain partners watch lists. Really excited about that because everybody uses the watch list for different reasons. We have a bunch of people that just use the watch list and trade manually. We have people that use it to help them guide their decision-making process in terms of what do they want to automate. So it's really a useful tool. I want to go back to our watch list briefly, and I did mention, and I think our trend spread is going to be updated in just a minute. I'm not sure if it has updated yet. Not quite. So that'll be updated in just a minute. I wanted to call out to specifically when there's a neutral ticker, we're going to show both strike prices, and it's not going to be seen on the wheel, but it'll be seen on the trend spread. So we'll get there, but we're going to be showing both strike prices. So if you did want to trade an iron condor, you could trade an iron condor. And, as we see people get more comfortable, especially new options traders get more comfortable trading spreads, they'll move into like iron condors and butterflies and these more complex option setups. And that tees us up kind of nicely to bring on our guest to the screen here. We are happy to bring back Matt Cashman from the OCC. Let's get Matt on screen.
Matt,
Hello.
what's up?
How's it going, guys? It's wonderful to be here.
We're excited to have you.
Fantastic.
Thank you so much for joining us today. Matt is a repeat guest on the show. We enjoyed him so much the first time around. We just couldn't help ourselves. We needed to have him back. Matt is an options nerd. I hope you're not. I don't think you're offended by that.
No, why would you be? Why would you be offended by being called an
Good.
options?
I just needed to make sure. He's an options nerd, just like us. We are very excited to kind of take a closer look. Matt is with Matt. You know what? Rather than me introduce you, give a quick introduction of yourself for anybody who might be new to the show here.
Absolutely. So I'm an options nerd, but that's first and foremost. So I started trading options in '99. I've been an options trader ever since then. Very brief history on me. I traded index and equity options to begin with. Started on the SIBO, on the board of options, the floor of the board of options. Then I moved to London and I traded interest rate options there for about 5 years. And then I moved back to the United States and started an index options market making business with some other partners and ran that for about a decade in Chicago, again, on the floor of the CBOE. So I have a lot of options trading experience, but what I do now with all of that experience is I work for the OCC, which is the Options Clearing Corporation. If you trade options in the United States that are either equity or index options, those options get touched somewhere along the lines by OCC, either in settlement or exercise and assignment. And what I do for OCC is I'm principal of investor education. So what I do is I teach people how options work, with the idea being that people who are better educated about options and the risks and the benefits of exchange traded options are going to understand their risk better and are going to be more well-informed users of the product. And so technically I work for the Options Industry Council, which is the educational arm inside the OCC. We're a non-for-profit that's fully funded by the OCC. But I teach people how options work all day long, and that's my job essentially. So that's what I'm going to do.
Awesome. Well, Matt, we had a great time last time you were on the show with us, and answered a lot of really good questions. We do have some follow-up questions to get to from that first show. I've got them written down on my phone here, and I'll ask. But before we get there, of course, when we have a guest on, we have to do some trader trivia. So let's get my screen up here. I made the question a little bit easier this time. So the question here is, which company became the first to reach a market cap of $1 trillion? Is it A, Amazon, B, Google, C, Microsoft, or D, Apple?
I seem to remember it being Apple, but I don't. That's my answer.
Final answer, locking it in.
I'm locking it. I'm not even going to phone a friend. I'm locking it.
Fine.
I just for the sake of not being on Matt's team here, I will say I do think it's Apple as well. But
I'm just go with the same answer.
No, I'm not gonna. I'm gonna go with C. I'm gonna go with C, Microsoft. I'm not even sure they're there now. Go ahead. Let's see what they got.
All right. First, we're gonna go to a did you know?
Oh, the clip. All right, hit us.
All right. Did you know that the charging bull on Wall Street, Dillon, we've seen that before. It was never commissioned by the city. It was installed by an artist illegally overnight. And it was actually taken down, but the public wanted it so badly that they put it back, and it's still standing there to this day. So this was back in 1989 that the bull was added.
Huh. Okay.
Pretty interesting, right?
Amazing. I love that story. I didn't know that. I did not know.
I
did
not know.
Did you not know? Have you visited? I'm sure that's a silly question, Matt. You got any pictures with yourself by the bull or what?
I think, if I dug into my Google Photos, I'd be able to find some pictures of me by the bull.
Excellent.
Yeah.
Now, Ben, can you give us the answer to Trader Trivia?
Yes, of course. It is Apple.
Okay. When was this?
It was almost, 6 years ago to the day.
Yeah.
All right.
August, and there's only a handful of companies now that have a market cap of over $1 trillion.
Is Microsoft? I was going to say, I don't even know if Microsoft's there now. Maybe they are. What are the other ones? Do you know? Do either of you know?
I think Microsoft is.
That would be a good did you know question. Let me do a quick Google.
Stocks over 1 trillion market cap.
Yeah.
Apple, Microsoft, Nvidia, Google, Amazon, and Meta are the only companies on the market to surpass $1 trillion market cap. That's from CNBC in July of 2024. So 1, 2, 3, 4, 5, 6.
Okay.
6 of them.
Recent enough. Can't count them on one hand. So
can't count them on one hand.
The United States is making more and more $1 trillion companies.
Why not?
Why not? Although after today, it's some of those companies might drop below $1 trillion. We'll see how the market goes today, but we are not looking pretty. We're not looking good pre-market.
Scary levels. Last night I was actually on with our partner Knott's BTF Bull Trade Finder, and he was taking a look at some charts, and I'm far less technical than he is, and a couple other people. They were looking at the charts, and they were clamming up a little bit. They were getting a little scared.
Well, hey, if you play the call side,
yeah, I was mostly on calls last week. I mean, my accounts, I didn't have a green week, but I'm not getting, totally beaten up here. But so go ahead.
So let's get into some of the questions we had from the last show that we didn't get to answer live, but came in afterwards. And if anybody does have any questions, feel free to chat us live. You could just send a message on YouTube, send a message on Twitter, text us, number on screen, 973-888-1166. We will answer your questions live. So, Matt, a question that came in after the show last time, and there's kind of two here that they kind of go hand in hand, but I'll start with just one. What time do assignments actually happen? So if you're getting your shares called away, or if you're getting assigned shares, you will fall asleep, usually depending what time you fall asleep, I guess, you'll fall asleep owning whatever shares or contracts you have. And then when you wake up, things will look a little bit different in your brokerage account. So like, what time do these things happen?
Yeah. So the real rule. So there's two things that you have to kind of incorporate when you answer any question like this, which is one, there are cutoffs that everyone has that are specific to their brokerage firm. So the first thing you need to do is make sure that you understand where your cutoff is. And when I say cutoffs, I mean, at what point in time will your brokerage firm no longer allow you to give them contra advice as to whether or not you want to exercise? For instance, if you're long calls and the stock finished below your strike, but it had earnings after the close and rallied through your strike, and you want to exercise that call, but it wouldn't have been automatically exercised as part of the auto-X process, you need to tell your brokerage firm, hey, I want to exercise these calls. At some point in time, your brokerage firm is going to say, no, you can't do that. Okay. So, and that time frame is different for every brokerage firm. They make the decision as to when they will allow contra or otherwise exercise notices to come in through them to like control their own operational risks, right? That's their prerogative. From the OCC's perspective, that cutoff time is 90 minutes after the close. So what that means is that 90 minutes after the close is the large cutoff time for OCC's actual like contra exercise notices or exercise notices to come in from our clearing member firms.
Okay.
So it bears a little bit of more explanation here, just to tell you where people sit within the kind of hierarchy of that. Generally speaking, people who have brokerage accounts are here. Then there's your brokerage firm, which has a relationship with the clearing member firm, which then has a relationship with OCC. And so you're going through multiple levels here. And at each one of those levels, right, those positions get aggregately bigger because of obvious reasons, right? There are more people that are feeding into the funnel. And so 90 minutes after the close is when our clearing member firms have to have their exercise notices into OCC. Then those things get matched up through an algorithm, through a random algorithm, and then exercises and assignments go back out the door to the end users through the same channels in which they came in. So that happens pretty quickly after the fact, after that 90 minutes. So the question is always a little bit tricky to answer because people want to know, like, at what point in time, like, where can I set my Apple iPhone alarm as to like when I should be looking at my account? Yeah. And the answer is it has a little bit of nuance to it, right? Yeah. That's why I build in like a little bit of explanation as to how the process works so that people can understand that it's not just something that like, at some point in time when your Apple phone goes off, you can like look at your brokerage account and know whether or not you actually got assigned, because it has a couple of different layers to it. But the cutoff time at the central clearing level at OCC for exercise or contra exercise advice is 90 minutes after the close. That's from the clearing member firms. Got
it. So 90 minutes after the close. So that leads to a question that I've actually asked myself and had somewhat of a difficult time finding online. But let's say it's the day of expiration, right? And you're holding, let's say you're holding a cash secured put, and the stock price is right at the money. And then let's say after the bell, the stock price drops into the money. So this is after the bell. Me as the cash secured put holder, I could still get assigned those shares, even though the close was out of the money, but after market, the price went into the money. All the way up until 90 minutes after the close, right?
Well, no, it's not all the way up until 90 minutes after the close, but
okay.
The reason why is because the person who is long that put has to follow the same kind of protocols that anyone else does, right? And so their brokerage firm might have a cutoff time that's 30 minutes or 45 minutes after the close, and so they have to be able to tell their brokerage firm to exercise before that becomes an exercise notice that goes all the way through the chain and all the way back down, right? But the answer to the question ultimately, I mean, the funny thing about this is there's only one way to fully remove assignment risk, right?
Get rid of the contract.
If I'm doing my job correctly, right, that I'm telegraphing that idea, which is when you are short optionality, particularly if you're short optionality in an American style option, you maintain the actual risk that exists for being short optionality the entire time that contract exists. Because at any point during an American style option, which is the majority of every equity option in the United States is American style, if you're short options, you have the obligation to make that contract whole if you're assigned at any point during the contract's lifetime, right? European options can only be exercised at the moment they expire.
Right.
That's the difference here, right? So if you're trading index options that are European, there's a different kind of risk headline that you need to keep in mind. But the question is, do you have risk after the close? And the answer is yes. But the real answer is, how do I fully close my risk? And the answer is, if you have short optionality, the only way to fully remove assignment risk is by closing your contract.
Understood.
Right.
Yeah.
Right.
I'm picking up on the fact that there's always nuance to the back end of options trading. There's always a million things going on.
So much nuance.
And I think also what's worth mentioning right now, being that, the buyer has the right to exercise their contract at any time here in the States. I just want to speak quickly to our trend spread strategy, which is a 7 DTE credit spread strategy. And it's built the way we, put it on paper is it's built to avoid assignment, because we're rolling contracts on the day of expiration around 12 o'clock noon. The bot is going to go in, close your current contract, open a new one. However, there are one-off situations where we can't say it completely avoids assignment, because if the buyer exercises on a Wednesday or a Thursday, you're going to end up with your shares. Now, please know that, for the PeakBot community and our automated traders, we're actually building in some logic into that strategy as we speak, to where if you do get assigned, the bot will recognize that, and it'll actually go in and sell those shares for you automatically. It'll sell a market order for the next day at market open. Just to get rid of that. So, and Ben has pulled it up on screen here, the details of that. And Ben, I don't know if you wanted to speak to anything else specifically on that, but I just figured that was a nice kind of segue into, what Matt was talking about and how it impacts our actual strategy.
Yeah, definitely. And like you said, Dillon, we are building in those automations to take care of assignment for people. So that way, if you wake up and you own 100 shares or you're short 100 shares, the bot will take care of that for you and get you back to that zero number that you started at. And I think that's a good transition to, you talked about our trend spread strategy. Now, typically when a new option trader gets into the game, they'll come across the wheel, or at least components of the wheel, where they sell cash secured puts or they'll sell covered calls. And then as they get more comfortable with options trading, and we're talking about the evolution of the options trader now, right? And somebody's curious They might start with covered calls. They might say, oh, I like that I can collect a little bit of extra premium on these shares that I'm already holding. They might use it as, in their minds, at least a form of income in that regard. Same thing for cash secured put. They could collect premiums off of that. So the wheel strategy or the components of the wheel strategy is typically where we would see somebody that's new to options trading start. And then we might see them get into spreads, which is, the trend spread bot thesis that you were just talking about, Don, right? Like we're selling credit spreads. We're either bullish or bearish, could be neutral and selling iron condor. And it's really at that point where that iron condor or butterflies, those more complex option strategies start to come into play. And PeakBot has automated that as well. And we'll get into the details of the iron condor in just a bit. But Matt, you've obviously got a lot of experience in this field of options because you are, as Dillon said, I didn't say it, an options nerd, but wear it proudly because he calls me that every day, and I'm proud to have that title. But Matt, what do you typically see as like the normal evolution of an options trader, and then like what were the complex strategies that those traders tend to gravitate towards?
Yeah, that's a great question, we see, generally speaking, exactly what you kind of just outlined a little bit, which is at the beginning, it's the kind of walk before you run vibe, right? Which is that people generally start with pre-existing equity positions, and generally speaking, they're long positions. So naturally, the outgrowth of that is, okay, I'm long stock. What do I do against this? And many times people immediately go to covered calls. It's a tried and true strategy that lots of people have used for a long time. The other side of that is that sometimes people trade protective puts. Obviously, there's a difference in the optionality part of it because you're long optionality with protective puts. When you're trading covered calls, you're short optionality. That speaks again to that entire diatribe that I just had about having short optionality, especially around something like expiration where you're dealing with assignment risk. But many times what you'll see is the outgrowth of a long position in an underlying kind of people leverage that to usually be short calls and long puts. Now, what those two trades are relatively simple, and many times people understand them kind of intuitively. After that, you'll see people a lot of times go to spreads, simple spreads. You guys and I have talked about this a lot, right? Put spreads, call spreads. And in many ways, it's easy to kind of take that understanding of how that one option works, right? Being short that call, and then understand on top of it, okay, now I'm short a call, but I'm long another call above it. Something like that, right? That's a short call spread. So a lot of times people will, step two, they go to short call spreads or short put spreads or things of that nature. And that is where the defined risk element of those spreads come into play, because you have both long and short optionality built into one trade. And so your actual risk exposure is really in between those two strikes. It's not outside of it. As long as you have it one for one, right? Those strikes are the defined part of your risk, kind of like your risk matrix. And so that's where people generally go to next. But what we see after that, and what we've seen really, especially over the last 5 years, because of, and I would say as in part because of platforms like yours, is that people are starting to think about slightly more complex option strategies. And I think that's because an automated platform like this makes it a little easier to trade it. And so what you're seeing is that people are starting to go more towards those strategies and use them more often because of that fact. And what we get when we talk about more complex strategies is iron condors, iron butterflies, things of that nature. And when I teach this thing, what I generally try to teach is exactly what I just described, which is like, we start with one option, we add another option, now we've got a spread. Now we take that spread that we understand the risk dynamics of, and we add another spread to it. And now you have this complex option strategy. Sometimes complex is not the best word to use to describe these, because I think it kind of like makes people freak out a bit about.
Right.
And I'm always on the hunt for a different word than that. So if you guys have one, we can bat one of those around. But when I talk about iron condors, I love to just talk. The way I teach it is I teach the call spread, I teach the put spread, and then I literally just take both of them and their P&L graphs and I stick them together. Right.
Yep.
It's like, okay, this is now the theoretical risk dynamic of what this looks like. And it helps people, I think, to understand, oh, okay, I already understand how call spreads work. I already understand how put spreads work. Let's just take them and stick them together, right?
Yep.
And that gives you an entirely different dynamic, a risk dynamic that is also still defined risk.
Right.
That's right. That's the part that people love about these.
So Matt, what's the allure for somebody that's getting into options to move into more and more complex strategies? Is it, they cut down on their losses further, they minimize their risks? Can they earn, do they want to earn more? Or do they just feel cool because they can trade these complex strategies now? What's the overall allure that you see?
Well, yeah, I mean, the feeling cool because they can trade complex option strategies, I can't necessarily comment on or encourage in any way, shape, or form. But what I can say is that if you think about trading call spreads and trading put spreads, and specifically being short call spreads and being short put spreads, when you're talking about something like an iron condor, you are short both a call spread and a put spread. And that is cumulative, not only from a risk perspective, but also from a premium perspective. Mm-hmm. And so the interesting thing about iron condors and spreads like that are kind of like, I would call them omnidirectional, right? They are, you have risk in a very specific part of the curve, but you are also capped, defined as far as the outside risk is concerned. But because you're selling both a call spread and a put spread, you have the cumulative premium that you're taking in on both sides, which generally speaking is going to be more than if you were just selling the call spread or just selling the put spread. And the interesting thing about this is I would challenge anyone to tell me whether or not an out-of-the-money call spread and an out-of-the-money put spread can both expire in the money at the same time, because the answer is they can't.
Right.
Right.
So you're going to win one side.
Yeah, exactly. Right. And that's one of the things that a lot of people, when they start to learn about these things, that sometimes provides their aha moment where they say, oh yeah, the call spread and the put spread can't be in the money at the exact time of expiration. And that is true. They cannot be. One caveat to that I should suggest, as I have to talk about risks and benefits, right? Not just the benefits part. The risk part is, and having been someone who's traded through many different market regimes and volatility regimes, I can say there were a lot of people who had put spreads and call spreads on in 2008, where it may not have expired on both the call spread and the put spread side at the same time, but in between the time that the contract was listed and the time that it expired, it traded through every single one of those strikes on both sides.
Yeah.
Like if you had an iron condor on, your call spread was in the money, and then you were, somewhere in between, and then your put spread went in the money, and then you were somewhere in between, and then your call spread went, that is a dynamic that can exist as well. So keep that on your radar too, right? Just because it can't expire where the call spread and the put spread are both in the money, in between now and the time it does expire, it can trade to where both of those spreads are in the money. And so, and that can, that's part of the reason why people like the defined risk part of this, because sometimes, there's a lot of people who will trade it and just say, well, it's defined risk, and I have a 1 by 1 by 1 by 1 complex option strategy on, but I'm covered. Right, on both sides. And so a lot of times people put them on and don't look at them, and that's certainly one way you can trade it. I would encourage people to, understand the risks of exactly what they have on. And if that's how you decide to manage your risk, then that's on you. But, the other side of that coin is that some people love to roll these things.
Totally.
Right?
Yeah.
And constantly be short the out of the money call spread and the out of the money put spread. And what that means is that in a market like this, where things are moving, if you want to constantly be short that at the money premium, you have to, constantly theoretically rebalance your position. In this case, I think you guys have strategies that kind of do it for you, right?
Right. No, you're absolutely right. And, first of all, really good explanation. I think our audience is really going to appreciate that. We're here to hit you with questions. So I have another one for you. And I was actually thinking about this. As an experienced options trader where you are today and an educator in the space, two things. One being, what would you tell the younger Matt Cashman, the Matt Cashman who's just starting to trade options? What would you tell yourself that you wish you knew then that you know now about options trading? And this can be high level, it can be something, rather specific, whatever it might be. Is there something that you've specifically that comes to mind that you've taken in over the years and that you've learned to be true that you would love to tell yourself as a new options trader, or anybody listening who might just be dabbling and dipping their toe into options? Is there one thing that comes to mind?
I mean, what a great question.
Oh, thank you.
So I listen to Scott Galloway a lot, Professor G, who's many of your listeners or watchers may know who that is. One thing that I saw him say the other day, which is great, and I think this is a piece of advice not only in trading but also that I would have told myself, just a life lesson. Things are never as good as they seem, and they're never as bad as they seem.
Wow, I love that.
Love that.
And what that I think generally does is it forces you to not only temper your enthusiasm when you're like, the full FOMO to the moon Reddit board, like let's go, that whole vibe. It'll stop you from getting on that train, but it'll also stop you from getting on the train that is, I remember, let's say this. I always talk about 2008 because it taught me a lot of really important lessons about life and trading. But I remember the day when the kind of like old guy who ran our, like sub clearing firm was in the kitchen with us before the open, and the SPOOs were trading like, I don't know, 690 or something. And there were 7 of us in there kind of like talking, blah, blah, blah. And he was like, what do you guys think about, where the SPOOs are going to be in whatever, 5 days? And he went around and was like, who thinks higher, who thinks lower? And everyone said they thought it was going to be lower.
Mm-hmm.
All of us, every single one of us. And he was like, he was like a 70-year-old guy, right?
Yeah.
He's been around the horn a couple of times. And so he said to us, like, I want you guys to all look around. Every single one of you thinks it's lower, right? And we were all like, I was relatively young. I wasn't like super young. I was seasoned enough to understand what he was talking about. But what he was basically saying is, if everyone in this room thinks it's lower, I can almost guarantee it's not going to be lower, right? And lo and behold, right, the low was 666 in the SPOOs, and we rallied straight off of that thing. I'm not saying that, like, there's no part of me that's going to go on a show like this and say, like, buy the dip or sell the rally or any of those things.
Right.
I do think there is a part of this where tempering your enthusiasm for both the upside and the downside, right? Things are never as good as they seem, and they're never as bad as they seem. Right. It's a good kind of like life lesson. It's a good trading lesson as well, I think.
It's a great take, and something that truthfully all of our PeakBot subscribers who had a tough few weeks, these last few weeks with these midweek trend reversals, and if they were more on the puts, and listen up, right? Like, you got to walk yourself off the plank a little bit. It's not the end of the world. You speak to exactly what, why we built PeakBot. Removal of emotions, right? Look, okay, you got to have a little bit. You gotta care. You have to care about what you're doing, but you can't be fearful. You can't get greedy. You gotta just stay tempered is the best word for it, as you said there. And we got to tell people, look, if you're selling options, which is again our bread and butter here, you're not doing this to get rich quick. You're not. You are playing the long game, right? You are collecting rent. You are doing this for a course of hopefully 10, 20, 30 years. I know, Ben, I do have one other question for Matt, but is there anything specifically before I do that we want to make sure we move to, or did you have anything for Matt or anything else?
I did want to get into butterflies because we had questions about that, but
Okay.
if you want to ask your question, you tell me. I don't know what your question is.
No, you know what? Let me ask Matt. I'm going to ask the quick question. You give me your quick version of the answer.
Okay.
When we started PeakBot 4 years ago, we knew we wanted to automate trading for the retail trader because there was no household name. There's still no household name. Hopefully that's going to be ours here in the next year or two. And we actually started with equity strategies, short-term swing trading equity strategies. And they were good. We started in COVID. We were throwing darts at stocks and they were making money. When the market turned around on us, we actually had an ex-floor trader, an options trader from Wall Street who was advising us at the time and said, guys, cut the crap. Stop, get away from equities. Go automate well-known option selling strategies and just collect premium for your traders. And at the time, truthfully, I'll say this, and the PeakBot audience knows that I'm the layman of the group. I had never sold options prior. Truthfully, I knew about it, but I had never actually gone out and sold options myself. And what I'm getting to here is online, FinTwit, social media, all these Discord channels, options trading in general. The buying side of options seems to have so much more lore and excitement around it than the world of selling options. It seems to be a very small world of option sellers out there, those who are specifically interested in educating around selling options, etc. I want to know, again, long question, hoping for, I guess, a shorter answer. Yeah, I don't want to cut you off. Do your thing. But when you are educating and your team is educating, how much of a focus is there on selling options, and why do you think that there's a way smaller community of option sellers than there is buyers?
Well, I would challenge the idea. Yeah. I would challenge the idea that there is a smaller community of sellers than buyers, because I think it's, the options world obviously is right. There have to be as many sellers as there are buyers.
Right.
I do think that from a professional's perspective, right? Like if you are a market maker and you are trading, many times as a liquidity provider, you are put into a position. You are not necessarily going out and putting on proactively a position. Your positions are a function necessarily of the order flow. And so if everyone is selling, you are buying the entire time. And if everyone is buying, you are selling the entire time. And so from a market maker's perspective, you have to be naturally neutral and be able to do both and be able to manage positions on both sides. Like if the market's giving me options, I have to be able to understand how to manage a long option position. And if the market is taking them from me, I have to be able to understand how to manage a short option position. There is one thing that I will say as to why that perceived kind of lure is there, I think, from your perspective. And that is because if you're short options, the most money you can make, if all you have is the option position on, the most money you can make is what you sold it for. Yeah. Right. Unless you have, if you have long stock against it and you're short a call, obviously that's not just an options position.
Right.
It's not a short. Mm-hmm. And so there's a difference inherently between the long option position, which has unlimited profitability on both sides, and the short option position, which has unlimited theoretical risk on both sides, but limited amount of profit potential. And so I think when you're, I always call it the sexy quotient of the trading part of it, right? The sexy quotient is the the get rich quick to the moon, everything's that whole vibe. We're dealing with leveraged contracts here, right? Like that's why I think people are drawn to it in some ways. But I also think that might be why people sometimes inherently are drawn to the long side or perceive to be drawn to the long side, like you're talking about. Because what's the whole thing? Like they ask people like what, like people like Warren Buffett or whatever, like, why haven't you told people, why haven't you broadcast more how to get rich, your strategy to get, and his, people like that always respond like, because no one wants to hear how to get rich slowly.
Yeah, exactly.
Right.
Yeah.
Everyone wants to hear how to get rich overnight. And like, it just doesn't, I mean, that's one way to do it, I guess, right? That's one way to, and it's like, it's your prerogative. You want to swing, you want to, get the heavy bat and swing for the, the back of the field, then that's cool. But I think it's, it's, from my perspective, it's all about like, you need to understand the inherent optionality and the leverage that you have on whether you're trading the short side or whether you're trading the long side. And then understand when it's appropriate from your perspective, from your risk tolerance and your like account, right? And your goals, when that optionality lines up on one side or the other side. And if it's the short side, then it's the short side. And if it's the long side, then it's the long side. The best part about our optionality is that it's inherently and extremely flexible.
Yeah.
If you want to, right? If you want to hedge something specific, it's available for you to hedge, whether you're buying that option or selling that option or buying that spread or selling that spread, it's out there. There's a price associated with it and a duration. And if there's a price associated with it, there's also an implied volatility associated with it. We can get into that in some other time, but understand what you're trading. Yeah. That's like, right. That's the basis of everything I do, right? Is like, okay, great. You want to trade complex option strategies? Awesome. Do you understand the risk dynamics of what you have on? And as long as you do that, I think you're so much better informed and better prepared to manage the risk after you hit the buy or sell button, right? Because it's not like whatever you do is just going to immediately like, oh, look, up 38%. Way to go. High fives all around. We're out, right? I mean, it's this iterative process. It takes a little bit of time. So that's my long-winded answer to your slightly
long-winded question. No, and it's really helpful, and it's true. I think you're right. Obviously, the options buyers and sellers are equal, but the perceived value is the newer retail trader. That buying side is probably just a little bit more sexy on paper because unlimited upside, whereas the selling you're capped, right? So, I think you answered that perfectly. Ben, what do you got, my friend? I know we got 12 minutes. Open.
I was about to say we've got the market opening soon. I think we might want to save butterflies for a part 3 with Matt.
All right. Yeah.
And that's a formal invitation to be back on, Matt. We had the audience show up. The audience always shows up when you're on. We have over 1,500 people on Twitter from what I can see. So yeah, fantastic audience. Again, anybody with questions, send them in. We could ask them next time, or we could try to get them answered before next time. So Matt will coordinate when that next time will be. But Dillon, why don't you send us out here?
I'll send us out. Matt, really appreciate you joining us as always. And Matt and his team over at the OCC and his education arm of the business are fantastic. There's a lot of resources that you can find and utilize yourself. I think to wrap things up here, it's really important. Educate yourselves. We're all about automating here, but educate, automate, elevate. That's the process in which you should follow here. If you're comfortable with the strategies in which you're trading, then automating them becomes really a no-brainer. So, Matt, thank you so much for coming on. Appreciate everybody joining in. And as always, we will see you at the peak. Take care, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.